This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, go to the homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, the title of the deck is Did the Market Capitulate? Did the market capitulate?
Well, certainly did. Last week when we had the chart book, we showed on page 2 the S&P 500 with that 200-day moving average and just the fragility of where it was. And one of the things I was highlighting is that any legitimate breakdown below that kind of 4,400 level had room for a downdraft toward 4,000. And pretty much we got, we got closer to 4,100. It didn't make it all the way to 4,000, but that very aggressive kind of puke selling really did come about. And this time you could really feel the fear. In the prior parts of the selling, we didn't see those reactions in the dollar and bonds and gold and oil the same way. And it seemed today that everything just had this enormous kind of like shit hit the fan moment that everyone just puked everything out. So with the S&P having this reversal, while it's very natural for us to get a bounce that could easily make it back to 4,300, even 4,400 back to that 200-day moving average is possible. So in between Friday and Monday, if this was a short-term low, a couple hundred S&P points to the upside as volatility contracts and you get that kind of gamma tailwind back to the other side, you could easily see a quick slingshot higher. But then when we get up there will be the real tell. If this was a legitimate bottom and a meaningful buying opportunity, we should see sustained follow-through beyond that of 1 or 2 trading days from an oversold market. And so while we probably do have a trading low that is of short-term in nature, it's still very premature to be saying that it's something more intermediate without more evidence.
Patrick, I love page 3 in your deck. We had Russia basically attack and disable Ukraine's air defenses, take over the Chernobyl nuclear plant, and completely neutralize Ukraine's defensive military capabilities. The VIX is unchanged on the day.
There you go. I think the interesting part about the VIX, okay, so we did get that big spike, that 38. It was very similar to the level we got back in January. The interesting part of an S&P that could rally a couple hundred points, and Charlie referenced it throughout the interview as well, is that volatility because of the dealer short gamma positioning could be just as volatile the other way. If we saw volatility come back into the mid to low 20s by next week, that becomes a short-term tailwind on the market to rebound. This is all very technical in nature. I don't think that the underpinning fundamental reasons why the stock market is in a bigger rotation aren't going to go away. But the thing is that I think on a short-term technical basis, there is lots of reason why the market could bounce here. Overall, that may not be the end of the bigger sell cycle yet, but the fact that we saw this kind of a pop and reversal in the VIX, it wouldn't shock me if we were in the mid to low 20s sometime next week.
Patrick, let's take a look at the dollar index on page 4. It looks like we got, all the way up to 97.75 or so on the day, and they gave back about half of it.
Yeah. The interesting part about this dollar move is going to be what happens in the next 2 or 3 trading sessions. I always like to say that one day does not make a new trend. And we had a dollar that was almost completely inactive in the prior 2 weeks. And in just one day, we had this big breakout that tried to break to a higher high and just didn't follow through at this moment. Now, we could continue to see some follow through between Friday and Monday, and it sustains at higher highs and starts a new trend. But if we see that the dollar index is gravitating back toward 96 by early to middle of next week, this could have been one complete false start, and that trade range dollar will be right back in play. It'll be really interesting to see whether the bulls can hold the gains.
Patrick, we've got the next three charts looking at gold. What's going on here?
Well, let's just have a conversation. You already in the market wrap were referencing that pop and drop in gold, and just wanted to give it some context here on page 5. Obviously, you're bang on with your levels. I think 1860 and even 1830 are going to be pretty important. Just generally, as gold here just pauses, so long as the bulls defend it and hold it at higher levels during a consolidation, it could still be a legitimate bull breakout. So it'll be really important at this stage with that the bulls buy the dip here in the next couple of trading sessions to solidify this breakout, and that's going to be what I'm watching. But one of the interesting things on page 6, which I wanted to highlight, was based on a conversation you and I were having, which was that while gold has broken out and has even worked its way higher, the interesting thing is that gold miners have generally been massive underperformers in many ways. And while the GDX, which represents the gold miners, the more senior, larger gold miners, is relatively flat since over the rolling 12-month basis. But the small cap junior gold miners were down quite considerably, down at 1.25%. But that doesn't even reflect some of the individual gold names. There's some great gold miners out there that in some cases were down 30, 40, 50% over this cycle. And the interesting thing is that even though gold broke out, not all of these miners have moved yet. And we're still seeing that no one has really kind of bought in that some new big trend has begun yet. It would be interesting to see whether or not the gold miners start to catch up, or whether the bullion trade is just a fake out.
Patrick, the reason that I wanted to include this chart today was it looked like we were going to close with gold up around 1970 or so. And what I was going to say is if you missed the boat and you missed the upside on gold and you want to get in after the fact, the way to do it is the mining stocks, because they haven't caught up yet. And presumably they would catch up. I think what we have to do is wait and see what's going to happen with the trend in gold itself. Now, this does look like a big reversal candle today, but don't forget that late in the day, President Biden vowed that U.S. forces are not going to fight in Ukraine. And the implication there is that means military action is not going to be taken by the United States, and that causes everybody who was afraid of this escalating to World War III to take a big, deep breath. Hang on. I think what he's really communicating here is U.S. soldiers are not going to be boots on the ground in Ukraine. That doesn't necessarily mean that we can't see other forms of military escalation, such as U.S. airstrikes and so forth. Now, I haven't read the full U.S. Statement. I'm not sure exactly what was said, but I think we need to find out whether it was a reaction to that statement that caused everything to reverse today, or if this truly was a buy the rumor, sell the news type of event, or what's going on here. But clearly, and not even just GDXJ, but if you look, as you said, at some of the individual issues, stocks like Cisco and Equinox are down 40% plus. And I'm not aware of any special fundamentals or anything that's gone wrong with the management of those companies. It's just that illiquid, small, junior mining stocks have been incredibly out of favor, and I think there's a lot of bargains out there. So the bargains are in the junior miners if we believe that this trend up in gold is going to be sustained. Now, I felt pretty darn confident about it, but today's reversal candle is a little bit scary to look at on the chart.
Yeah. I wanted to just add a supporting chart to that argument. If you go to page 7 and you look at the gold miners bullish percentage index, what you can observe here is that numerous times we see some incredibly oversold and overbought conditions when you look at the entire gold mining space altogether. And we obviously saw some incredibly oversold gold mining conditions going into the tail end of last year, where we had only 20% of stocks actually on the miners giving bullish signals, which is a pretty oversold condition. What you can observe here, even with this breakout in gold, we're not anywhere near over 50%. If there is going to be an emergent trend here, it hasn't even really begun. And so this is why it's such an interesting space to watch whether or not it can follow through, because there's probably a lot of upside here in the miners if this bull trend can actually go. But anyway, Eric, I wanted to move on to page 8 and just really show that chart on crude oil and the way that pop and drop occurred on that candle. I'm actually so surprised to just see such an enormous intraday reversal. Now, usually this kind of volatility can happen over several days, but I mean, just to happen literally within a span of 6 hours from the top to bottom, just running up and then running back down, just amazing move, isn't it?
Well, here's what I think might explain that, Patrick. Of course, the big move up was the fear of, here we go, if the U.S. gets into a war with Russia, or if the U.S. imposes oil-related sanctions on Russia. Boy, oh boy, the crude oil market just cannot tolerate the loss of Russian production. But hang on, now the sanctions have been announced. Biden has said U.S. forces will not fight in Ukraine. To me, that statement is a little bit ambiguous as to whether it means that U.S. airstrikes will not occur in Ukraine as well. But one way or another, there aren't any oil-related sanctions, and the other sanctions have been announced. So it seems pretty clear that the White House strategy is to find ways to sanction Russia that do not impact energy prices, because obviously they're very concerned about energy prices, and I think that probably explains a lot of the reversal. Now, I still think that for reasons that have nothing to do with Russia and Ukraine, that we're headed higher on oil prices, but we've come awfully high, awfully fast on this Russia fear. And if what we're seeing is the market recognizing that, yes, the Biden administration is going to be aggressive with sanctioning Russia, but it's not going to be energy-related sanctions, maybe that's the reason that we had such a big reversal candle today, and maybe there's still more downside to come. I think that that's a buy-the-dip opportunity, though. The question is, how much more downside is there before that buy-the-dip? We're going to have to see how things pan out in the next few days.
Oh, for sure. But what I wanted to interestingly highlight on page 9 is when we look at the actual energy companies, what I thought was really interesting was that the energy stocks, the ETFs that in the different basket, whether oil services or exploration or those fully integrated large cap ones, while oil was ripping to 100, there was some very active profit taking in this space. And many of these energy names were actually down on the day while oil was ripping higher. I thought that was an extraordinary divergence. And one of the interesting things about that was when you look at this bullish percentage index, we saw us hitting 100% again just a few weeks ago. And what we're already down to 76%. There seems to be quietly some active profit taking that's starting to happen in energy stocks while oil is holding up. Now, I don't know if I want to overread into this just too soon, but it does seem like the energy companies have lost a lot more momentum than oil itself. And I wonder whether that actually is something that we should be reading into, or whether it's just the energy stocks were a little overdone and will eventually catch up.
And Patrick, we can see uranium moving up on page 10.
Yeah, interesting. Obviously, a lot of uranium comes from that part of the world where Russia resides, and a lot of that political uncertainty has certainly on the short term upticked some uranium. It'll be interesting to see. Uranium's been incredibly quiet for the last 6 months, trading in a sideways consolidation, just using the Sprott Physical Uranium Trust as a proxy on the price of uranium. It'll be really interesting to see whether whether uranium prices on this actually start to rise and whether this in itself can actually become bullish for the space. Well, Eric, though, I wanted to move on to the chart of wheat on page 11. And really what was interesting is obviously Ukraine supplies a lot of these grain products. And while I showed the chart of wheat, the prices of corn and soybean have just been ripping. It's been a huge reaction in the last few days. But what I thought was the most interesting about this is that that wheat and these grains have not given back the gains the way gold and oil did. And I thought that was interesting, the fact that these are actually holding up. And I wonder whether that actually means that there's more upside on these.
I don't claim to understand what's going on here, but just taking a guess, Patrick, I think what may be going on is that the Biden administration, although I'm not aware of any wheat or other grain-related sanctions being announced, they seem to be focusing on non-energy related sanctions. So a lot of wheat and other grains get grown in Russia and in Ukraine, and if they're going to target something for economic sanctions, it seems like it's not going to be energy, so it's going to be other things. Maybe that's what's driving the grains up. That's just a guess. Let's move on to page 12. We've got investment-grade corporate bond spreads. What's going on?
Well, I just wanted to keep highlighting that while we have seen these reversals in the markets on an intraday basis, the one thing that we continue to see is that credit spreads continue to rise. And while they have not in any way blown out to levels that we have seen like during the COVID events or other things like that that have caused a lot of stresses in the market, they are generally trending higher. And I think before we, like right now, while the stock market might be overdue for an oversold reaction to the upside, I think that in order to have a more sustained rally in the markets, I think that a lot of the credit risks need to subside. And at least initially, we're not seeing that happening yet. And so this is something that I think I'm going to keep watching over the next week or two.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's service. Information is on slides 13 and 14 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.